Super excited to welcome Erik Wetterling of the Hedgeless Erik, I'm just a huge fan of your investment style. It literally aligns perfectly with the mission of this podcast, which is to find undervalued assets that have multi-bagger potential that are early stage. So welcome to the show.
Thank you.
Yeah, again, just a huge fan of your investment methodology and trading style. So do you just want to share with people kind of like what that involves?
It's a bit complicated because, investing, it really is an art, not a science, and you pick up stuff all the time, and no case is really exactly the same. Any stock you see out there, that's basically one hand you can play, and they are all different risks, different upside scenarios, etc., etc. So, it's like, I don't think you should be looking for perfection, but with that said, I do think that it also means that you really should think about margin of safety, because if we're talking long-term results, compounding is the main goal, basically. If you could average 20% per year, which is a lot over 10 to 20 years, you're going to be rich. Okay, if you start with $1, it might be pretty hard. But otherwise, that's the main goal. But most people, like 95% of people, don't beat an index. Why is that? Well, I think there are a few main reasons for that. One is people being short-sighted. They overvalue the near-term catalysts. They overvalue basically anything that could make them rich within, let's say, a month or two. That's going to be very enticing to people because people want to get rich tomorrow. If you said to someone, especially in the mining business, which I invest in, if you could guarantee a 50% return on a stock in 12 months, I don't think everyone would buy that, because I think that would be too low of a return in their mind, even though if you could only find 50% returners in 12 months and keep that on a rolling basis, you would be richer than Warren Buffett at the end of the day. So that's like one of those obvious things that I think people get wrong. They're too greedy and end up, shooting themselves in the foot. And that also brings me into the, in my opinion, fallacy of the 10-bagger. I want multi-baggers as well, but a 10-bagger basically by definition means that you're taking an obscene amount of risk. And people think that in order to have said 10-bagger, they think they need to be in the riskiest stock there is, which is doing a maiden drill campaign, and they just have to take the first assay risk in order to have said 10-bagger. But if you actually look around the juniors, even the ones who have, made significant discoveries over the last 10 years, there was not a single stock that went up 1,000% in one day. Many cases like today, for example, we have Great Bear Resources, we have Newfound Gold, we have a bunch of stocks that already made a discovery hole and then went up 10 times. And that's like, 3 in, 2,000 companies or whatever. So it's like, in reality, people think that in order to have great returns, they have to take the maximum amount of risk. While in reality, the market seldom prices in everything within a day. So even if there are some exploration stocks out there that do hit a barn burner hole, as they say it, and it goes up 80%, you're going to have a lot of people that think, well, I missed the boat. And you read in the forums, this guy said, he was heavily invested and he's up 80%. And it kind of, I think it rubs people the wrong way, seeing someone who, is up 80% on a big position. And they're like, yeah, I'm not going to help this guy get even, better returns by buying in. So I do think that's also an, aspect, envy, basically, or jealousy, or however you would call it. But in reality, most of the time, those kind of stories, if they're up 80%, they might be a much better buy, or even double or triple, whatever. They might be a much better buy than the day before, simply because the risk has decreased exponentially, and there's now a good likelihood of, let's say, it continuing up for like 500%. I'm beating around the bush, but I guess what I'm saying is that I think it's a bad idea for people to think that in order to get a 10-bagger, they need to be in on every exploration play that are drilling their first holes. That's how people get killed. I've done it myself. I mean, my biggest loss was one of those plays. The company had one project, had enough money to do one drilling campaign, and they missed. It went down like 60%, and I don't think it has done anything in like 3 years. So that's almost, I mean, for all intents and purposes, that's almost a permanent loss. So that money, imagine the opportunity cost of, instead of losing 60%, you had that money and you could compound that for 20 years at 20%. That mistake is gonna be very costly for myself in the long run. And it just comes down to, trying to make the least mistakes as possible, because nobody's perfect, and I do make mistakes as well. It's just that I think I'm a pretty quick learner, and I always do my own due diligence, etc. If I never buy a stock because someone recommended anything. If it doesn't make sense to me from a risk-reward standpoint, I won't buy it, no matter who recommended it. And I have a background in poker, which is all about expected value and odds, etc. So I'm strictly, I'm very mathematically skewed, I guess, when it comes to looking at risk, etc. And I don't think many people have that background. So that's why I think I see some mistakes, etc., that many people do that they wouldn't have done if they had played like 1 million hands of poker, for example.
Yeah, totally. I play poker too, and I know how grinding and boring and like disciplined it can be, because to make any money, it's not really fun if you play the right way, right? Because you're just so focused and like grinding through all the bad cards. So that's good that your discipline applies to investing too. That'd be really helpful.
Yeah, I do think that's my main edge, actually. I mean, I have studied economics and business economics, but it's like when it comes, in practice, it's probably the poker, the discipline and the concept of risk, or what are you paying for a company and what's priced in, etc. Because you see it all the time. People say, I won't buy this company because there's a risk that this will or will not happen, and they don't even bother to look, okay, what's priced in. I mean, if a company is trading like, there's a 1 in let's say 10 chance, I mean a 10% chance of them making a discovery, and it's trading like 5%, like it's a 5% chance. I mean, it's basically the expected value is twice what it's trading at. I mean, from a pure mathematical perspective, that's a buy, simply because so little of it is priced in. But many people look for certainties, and I think they overvalue stuff. Same case. I mean, you can see people talk about this is the, I don't know, perfect deposit, or this is so good, etc. But yeah, sure it is, but it's also perhaps, pricing in that it's just going to keep getting better and better. And then the risk reward is pretty bad, because I mean, you're already paying for maybe a lot for something that hasn't happened and have really no guarantee of happening. While if you buy something that is so cheap in absolute terms, I mean, that just at face value decreases the chance of you making a mistake. Because I mean, risk, in my opinion, is not the risk of a stock going down on any given day, or having a Corona flash crash and see portfolio go down. That's volatility, sentiment, and a market crash. I mean, that's like a force majeure. Risk, in my opinion, is overpaying for something, a scenario or whatever that ends up not being true. So basically, a stock that goes down and has all the reason in the world to stay down. But if you buy something cheap at $1, it goes down to 50 cents per share, and you think it's worth $3. If you're right, that's still going to hit $3 per share. It just means that, I mean, in the short term, you're sitting at a 50% loss. But the worst mistake, obviously, in that case would be to sell it, because you're missing out on a six-bagger up. And that's going to be extremely costly. So that's one of the things I've done. I never, ever I didn't sell a share during the COVID crash. I never sell if something is down, like, I mean, if the index is down a lot or whatever. That just, I mean, by definition, since we know everything oscillates up and down, every additional day that a sector, etc., goes down, that also by definition takes it one day closer to the shift in sentiment. So I'm like you, I basically started out with saying earlier, I mean, I do catch falling knives all the time, because that just decreases the chance that I'm making a mistake. Because if nothing has happened with a company and it's down 50%, so if I was making a mistake buying it before it went down, sure, that might be the case. But now there's like a 50% decreased chance of me overpaying for it relative to where it started out, in a prior period. So again, it's like I don't get the whole don't catch falling knives, etc. Well, I mean, there's some rationale behind that, obviously, that people want to see, good upward trends, etc. But I think my biggest wins haven't been I mean, that I have had like 2 10-baggers, I think, or one this year. But other than that, I simply go very big when things are really cheap, and I'm usually happy with having a double. I mean, I could be out then, because at some point, some companies become so cheap that you just know it's really a matter of when, not if, they're gonna double. So sometimes I have obscene positions that for a while are in deep red, but when it turns, my upswing becomes exaggerated since I have such a concentrated position. So, I mean, I've had 4 or 5 periods where my portfolio has gone down 40% or more in the last 5-6 years. But after every bounce, since I position myself in even better names that might, have seen an exaggerated decline, the next top in my portfolio is almost always higher than the previous one. So it's like I have incredible swings along the way. But since I stay in the game and just basically reshuffle my portfolio into even higher quality names, because, I mean, in the COVID crash, some of the tier 1 juniors out there went down 60%. I mean, I could probably, put my whole portfolio into, some of these plays, just one stock, since it was so unreasonably cheap, given that they have a tier 1 project. And if any project in the world is going to get built, it should be that one. So it's like you have to be as calm, cool, and collected, and realize that you don't need to know where it's going to go tomorrow, yesterday. You don't even need to know where gold is going to go tomorrow or 3 months from now or whatever. If it's cheap, that's all you need to know. If it's cheap at today's gold price, maybe it's even cheap at $1,500 gold. And in that case, you have a big margin of safety as well. And that's all I try to do. I don't try to be too cute. I don't try to trade. I don't try to guess where gold and silver is going. I just look at companies. If it's cheap, I'm buying. If it becomes cheaper, I'm buying more. And that's it.
Yeah, that's very wise. And I love that too. Like the worse the chart looks and the deeper red something is, the more I like it, right? The more you want it. That's how I am. And that seems how you are. And it seems to really work out almost every time you buy. Like, not every time, because sometimes some things really could have bad fundamentals. But let's say it's like a good ETF or something and it's deep red. That's when you want to buy. But that's why your poker background's great, because you take all the emotion out of it, right?
No, exactly. That's the thing. It's like in poker, you could know that you have that worst hand. Let's say you're sitting on 2-7 offsuit, and you know that the other guy might have aces, and depending on how big the pot is, I mean, how much you could win, if it costs you, you know, just a few, I don't know, dollars, let's say, to win you know, let's say it costs you $5 to play a hand, and the pot is at, you know, $100. So that's a 5% chance you would need basically for a neutral bet. And your chance of, you know, your win chances, I don't remember so many years ago, but I think it's like, you know, 16%, 15 to 18% versus aces. So in that case, I mean, I think that the moral of that story is that at some price, pretty much anything becomes a buy, simply because so much negativity is already priced in. All the negative scenarios you could think of are priced in. I mean, there have been companies during the bear market, the miners, that were trading at cash. I mean, they could basically burn down their projects, give away the projects, burn down the office buildings, fire everyone, and just hand back your cash. So it's like, I mean, that's not really a risky investment. I mean, in theory, that shouldn't even be possible, but it happens, which also shows that this market is far away from being efficient. And I think that's like one of the biggest, I don't know, you know, the greatest trick the financial industry ever pulled was, you know, convincing people that the market was efficient, because there's no way that if the market is efficient, there's no way I could, you know, be crushing the index like I've been doing over the last years. No way.
Thanks for sharing your methodology. I think it's really valuable for people to learn that and take notes on that. But then moving on. So like right now, you know, looking at the landscape, just starting macro, what areas do you think, you know, have the worst sentiment, are the most undervalued, you know, given your trading style?
I'm pretty simple. I try to stick to my, you know, circle of competence. I mean, it took long enough to just figure out what gold mining was all about, how exploration works, what kind of different mineralized systems there are, etc. So I'm just trying to stick to that, because I mean, at the beginning, I mean, the whole point of me getting into gold and silver, excuse me, was because, I mean, I was pretty sure that the, you know, financial system was FUBAR. So, okay, if you think that's gonna, you know, happen, I mean, mathematically it will collapse. So, I mean, that's not a question of if, it's a question of when, basically. I mean, if it becomes debt default and deflation, I don't know, if it becomes, you know, hyperinflation and then you go into a reset of the currency, who knows? It's just that mathematically this is gonna end badly. So that brought me into gold and silver. And then I just, you know, basically when I thought there was no point in me reading up more about the debt bubble financial system, because I was already convinced that gold, silver, and real assets was going to be the place to be over the foreseeable future. Then it led me into mining stocks. And other than that, it's like I recently looked at oil, for example. I just know it's, you know, down a lot. Sentiment was, you know, poor. But the thing is, like, I don't know oil companies. I can't look at a presentation and even have, you know, the slightest clue if this is overvalued or undervalued, or you know, what it means if they hit like 12 meters of net pay, yada, yada, yada. That doesn't tell me much. So even though I think that, for example, even if I believe that the oil market had a better future relative to gold and silver, I think the fact that I understand the companies and the company's prospects and fundamentals so much better, I think I would outperform another version of myself who went into the oil sector simply because he believed the price of oil was more, you know, had a more bullish trend than gold, but had really no clue what to buy. I mean, I would have to become a trader in that case, basically, and I hate trading. So I just try to stick to my circle of competence, and that's gold and silver. And the main thing there is like, I'm thinking like, if I can pick the best companies possible, I should do okay in a bear market, even if it, you know, a month or 2 years or whatever, and I should do okay to great in a bull market. It's sort of, you know, hoping for the best, preparing for the worst, because I'm convinced that gold and silver is very much in a bull market. But I try to pick the companies like we're in a chronic bear market, basically. And on that point, I hate beta investing. I hate optionality plays. I don't see the point of that, because then you have to have the timing right, and there's no really intrinsic growth most of the time because the projects are so mature. So it's just, I mean, if you pick a good alpha play with a lot of growth, if it takes 2 years for the bull to really get going, if the management team is good and the project is good, if it takes 2 years for the bull to get going, they will have created a lot of internal value. So when the price of gold doubles, maybe the value of the company, even before the rise had, went up 5 times. So that's going to be a 10x in terms of intrinsic value when you factor in the increased price in gold. But an optionality play might really not have changed in 2 years. But then you get the big spike in gold, and sure, it's going to go up, etc. But you don't know when that's going to happen. So again, it's like I try to control what I can and invest like it's the shittiest market ever, even though I'm in this market because I think it's the best ever.
Yeah, that makes a lot of sense. And, gold and silver have underperformed, tech and some other big names the last few years. And you've managed to beat the index even in this environment, which is pretty awesome. So do you currently see value in the space now, even though it's come up a little bit, right? The gold and silver miners are somewhat elevated.
Yeah, no, for sure. I mean, I think it's possibly the best environment I've seen in the last 6 years.
So, what a lot of people are wondering, and, this isn't a recommendation to buy or sell, this is definitely not investment advice, but like what people might be wondering are like, are there any companies that interest you right now that you see some value in? Obviously the story could change next week, but are there anything that like currently has some value that interests you?
I mean, I think I own like 30 companies right now. I've never been more diversified. I simply think there are so many good stories out there. And yeah, I haven't seen anything like this really. I mean, let's say 2015 during the gold and silver bottom, gold went down to like, $1,040 per ounce. Sure, companies overall were a lot cheaper, but the problem back then was that the companies had no money. And the gold was at 1,040. So, but right now, I think, I mean, they're up on average, let's say a few 100% since then. But gold is up a lot. I mean, gold has almost doubled. It's almost sitting at a double. So I think that a lot of gold juniors, especially, and increasingly so silver juniors as well, they are not reflecting the current gold price. So on average, I think that the opportunity out there especially junior mining stocks, is really great, and that's why I'm basically not that people should do this, but I've been practically all in miners since 2015. So it's like, again, it's like I have huge swings. I have, well, yeah, a lot of money at risk, let's say. On a day-to-day basis, but that's simply because I see so much value. Otherwise, I wouldn't be in this sector if I didn't think I was buying stuff, on the cheap. And I see stuff. I mean, I could name a few that are which I consider to have some margin of safety. That it's not pure exploration plays. I don't expect any of these to like go up 10x tomorrow. I do expect that most of them are pretty cheap to very cheap relative to what they have. And I see a pretty clear path forward for growth. So I think, these companies should go up like at least 100% in the next 12 months, barring a market crash or gold, crash or whatever. But I expect at least 100% from these, and that might sound boring to people, but it's like if you can take 100% return, a relatively high probability return like that, again, you're going to be rich as hell in the long run. So it's like, okay, one is ROKMASTER Resources, ticker RKR.V. They're in Canada. They have a big gold resource already, and they have had a lot of drill success. So based relative to what they already have, I think it's super cheap. Relative to what I think they might have, I think it's extremely cheap. And it's in Canada, tier 1 jurisdiction. Probably going to be an underground mine if they do put it into production, and it's easier to permit an underground mine, etc. The only thing is that they need to pay, I think it's around 40 million Canadian to actually acquire the asset. But I mean, I don't see any problem with them coming up with that money, because even if you double the market cap, I mean, if they raise that money today, so you double the market cap, I would still say it's cheap, especially relative to where it's going to go. But I think that's been punishing the stock, etc. And you know, I own it. I don't have a problem with it. It's just so cheap. Cabral Gold is another one. Ticker CBR.V. That's a Brazilian play. They have a very large land package in Brazil. They have around 1.5 million ounces already in a resource. They have more targets than I can name or even almost count. There seems to be gold all over the place there, and they've been drilling all over the place, and they keep finding stuff all the time, high-grade veins, low-grade disseminated stuff. They recently discovered that there's a thick blanket on surface with like eroded rock that's I think one intercept right on surface graded 6 grams or something over 30 meters, something like that, which is pretty crazy in itself. But it's just made up of pre-existing loads that got eroded and now is sitting like basically soil and rocks at the surface. So that should be pretty economic to put into production. So I think that changed the case. The market hasn't. Well, they're raising money right now, and I don't think the market fully appreciates what a game changer that is. Then we have Grande Portage Resources, ticker GPG.V. Very high grade play, Alaska, the southeastern tip of Alaska, along the coast of British Columbia, basically. Very high grade, over 1.5 million ounces. It's located near to mines owned by Hecla Mining and CORP Mining, and those are multi-billion-dollar companies. So it's like, okay, you get you know that, okay, that looks to be a pretty good place to put a mine because there are mines there. So it's like it's permittable. And then you have the fact it's very high grade, which is always, you know, great, because companies that can, you know, one could expect margins could be exceptionally high. I mean, theoretically, and that's an asset, you know, anyone would want to own even in a bear market. So, I mean, I just love that fact. And I think there's a lot of probable growth ahead. And I think that could be a multi-bagger. And the fact that it's in a tier 1 jurisdiction, it's just great. Then I mean, should I go on? I have a few more.
Yeah, I mean, that'd be great. But just to start, just look at these. These all $60 million market caps and below. You're saying a lot of them do seem like they have to raise money, and that could, you know, dilute shares and raise the market cap even more. Do you think these have potential to go to like 200 million given the resources they have, the three you mentioned?
Well, I mean, on paper, for example, ROKMASTER Resources project, I think it has a net present value. The let's say, you know, old resource. I mean, they had so many hits that it's obvious that it's a lot bigger than what they have on paper. So basically, but on paper, the project is worth around, I think, over 400 million at $1,500 gold, something like that. And it's obviously not even close to that. So you can imagine what it might, you know, be worth on paper if they, let's say, double the resource and, you know, you use what the actual price of gold is right now. I mean, that kind of, you know, shows that, okay, nothing of that is, you know, priced in. So, and that's why I think the risk reward is great, because the gold they have already, and the silver, and they have a polymetallic stuff as well. That's not going anywhere, and that's where the margin of safety comes in. And then, but the risk is, okay, the 40 million that they have to fork up to actually acquire the project. But I can see how one of the largest undeveloped projects in British Columbia wouldn't get interest. I mean, I just don't see that, because there are not many multi-million ounce mines around, especially in tier 1 jurisdictions. So that's, in my opinion, it's like the market is a bit greedy, I think. I mean, and skeptical or whatever. So I expect to make a pretty good return on that, and I do expect that to be acquired one day. And Cabral Gold, I mean, yeah, they have a lot of growth. I think even though it's Brazil and that gets a discount, if they can show, this is more close to, I don't know, 3-4 million ounces, and they have that near surface oxide blanket, which could be very economic. I mean, yeah, I think it's going to be, I expect to have a multi-bagger on that too. And yeah, Grand Portage Resources, I do think, again, relatively high probability. I can't guarantee anything, but I see that as a high probability of growing further. And I don't see how 60 million Canadian minus 4 million in cash for a 1.5 million ounce, very high grade asset in a great location jurisdiction. I mean, you don't see that every day. So I don't think, I can't see how this is expensive. And I do expect, I mean, they've explored like 30% of the property, and the veins they have already found are like wide open at depth. And they have, so far, they've hit in every of the 176 drill holes. So what does that tell you? Do you think they might hit in the 177th drill hole? Yeah, I think so. So it's like, I mean, this is not rocket science. It's just, in my opinion, that's why I, almost, I wouldn't say frustrated, but I think it's ridiculously easy to beat the market, because this is like, simple stuff. Sure, can it take some time for it to, show a profit, etc.? Sure, but I mean, again, it's like, I mean, if you know what to focus on and just, focus on the important things, I mean, I think the market is a joke, especially the mining sector.
Yeah, no, that's really awesome. Thanks for sharing those. And it probably is better for you to share more names, just because you don't want everyone to just go all in on a few, because some people will. But again, it's not.
Yeah. Yeah, sure. I mean, there's another Brazilian play. Keep in mind that I own all of these, and yeah, everyone is a sponsor of the Hedgeless Horseman also. And I try to bring on the ones I own to, a win-win situation. But consider me biased. Do your own due diligence. I can't guarantee anything.
All right.
I just can guarantee that I own them, and I'm biased. Tristar Gold, another Brazilian. It's pretty boring because it's not a sexy project at all. Ticker TSG. .v. It's not a sexy project at all. It's low grade, or relatively low grade, but it's a multi-million ounce system. The economics are great. I think at today's gold price, I think the net present value of the project is close to 700 million US. The enterprise value today is around, I think, like 50. Something like that. Again, you look it up for yourselves. It's just one of those, you're buying something for way less than 10% of face value, and it's gonna grow. I think I think it will be taken over one day. I mean, that the economics are so great, but in the eyes of the market, the retail people, I mean, low grade deposit, Brazil, it doesn't get any sexy drilling results, basically. So that's why it's cheap, but that's one I think that, it's again so cheap that I don't see how I could lose money on it. Let's say it like that.
Right.
And then we have Novo Resources, a favorite of mine, which is very controversial. Most of mining Twitter, etc., hate it. and I love it. It's been very frustrating from a performance standpoint over the last 2-3 years. I mean, it's basically gone nowhere the last 2 years. But I think in terms of just absolute blue sky potential, that by far has the highest in the whole mining space, in my opinion. But that's also not priced in at all, in my opinion. But the road there might be, I mean, first of all, there are no guarantees that said blue sky will materialize, and I have no idea how long it will take. But I mean, I've written hundreds of pages on that company, so it's going to be hard to sum it all up, because they have the biggest portfolio of any junior. They have the, I think, largest land package of pretty much any junior. They have multiple different types of exploration projects, and they are ramping up a mine. I mean, that's like, in terms of just assets and projects and targets, that's like buying a major, but in the shape of a junior. But it's hated, and that's why I consider it to be cheap, because obviously if everyone loved it, everyone thought the same as I did, I wouldn't see the opportunity. But right now, that's not the case. So that's one. Ticker NVO.V. And yeah, I can take one last here. Timberline Resources, Nevada play. They have over 500,000 ounces of gold in the ground, and Nevada is one of the, you know, I mean, the best jurisdiction probably in the US, no doubt, but it's like a top 3 jurisdiction in the world, basically. They have 500,000 ounces. They're gonna drill, I think, 8 to 10,000 meters or something like that this year, looking for Carlin style gold deposits, which are very sought after. But you know, it's again, it has some of that margin of safety. 500,000 ounces already. That's not going anywhere, regardless of what, you know, they find with the upcoming drill campaign. So I like that, and I think there's some low-hanging fruit. I do expect them to hit stuff, and they're going to be drilling low-hanging fruit stuff, as well as a bit swinging for the fences, new exploration targets. So I think I like the way they're going about it, because they know that in the eyes of the market, it's gonna feel better if you have, some success. You drill some holes, you get into the, well, people love to see some success always. If they just burned everything on, long shot, high risk, high reward holes, I mean, that could basically kill the whole momentum and the sentiment in the stock. So I like that they're gonna do both a little of low hanging fruit drilling, which I expect they'll have some hits in, and also see if there's something much bigger. Ticker TBR.V. Those are some of my 30 plus name portfolio, and again, it's like, don't bet the farm on any of one of these. I own them because I think I'm going to make good money on all of them in the coming year or two, but I'm again very diversified, and it's like, if one fails, no big deal. Two, no, not great, but I don't see again, I buy them because I do think they're going to go up, but they're not. I don't see them becoming 10 baggers in the next year. Let's put it that way as well.
Gotcha. No, I love it. It's like, and I can see why you'd be beating the index, because the index might have a bunch of, like the GDX, right? Or GDXJ, that might have a bunch of stuff that's already moved a lot, and there isn't as much price discovery. Whereas if you buy a bunch of these, like a bunch of them diversified, you can definitely beat the index, especially if you've done the research. So,
yeah, no, I think so. It's like, it doesn't hurt that you're much more able to sleep, let's say, because I mean, I had a period where I could be all in a stock. That's not the Hedgeless Horseman today. That was a bit over the top, but at the same time, I mean, it was exciting. But like now, I'm so diversified that I don't even really need to look at the portfolio, because I think that all will perform on average very well on a 1 to 2 year horizon. So it's like, why do I need to look at what the 1% position did every day? So it's, in terms of peace of mind and quality of life, I think it's the best way to go, because you see people obsess about, and I used to do the same. They're too heavy in one stock. They obsess about it. They're in, reading everything they can every day, looking at the price, trying to, if it goes up, they're thinking, yes, this is going to be great. If it goes down, they're thinking, oh shit, someone knows something. Now I won't be able to sleep. So it's just not a great way to live your life, because, the whole point of investing is that you're paying people to do the labor for you. So you won't have to, do the labor. But if you're watching the stocks, your portfolio every minute of every day, you're wasting your life away, and it won't change the fact, it won't change the price the more you look at it. So it's like one of those things that I don't do that. Don't get too involved with one stock that you constantly need to waste your life by looking at something you can't control anyway. At least if I'm looking at my portfolio, I'm more diversified than ever. But it also, one reason for that is also because I've been in so many private placements recently. And that's also one thing I really think people should pay attention to, because if you get into a private placement and you get, let's say, 2-year warrants, that's just risk-free upside. It totally skews the risk reward. It's like, it's like playing a hand of poker. And if you win, let's say you play heads up poker. If you go all in versus the opponent, it's not just that you double your money. You would get, like, let's say, triple your money. But the downside is the same, because you're not paying for the warrants. So it totally skews the risk reward. So in an ideal world, my ideal portfolio would be 100 different exploration companies, private placements, and you had full warrants. Because that's going to be so diversified that without warrants, maybe you need 1 in 5 to have a real success. Probably, perhaps more than that. Anyway, but if you have warrants, etc., maybe 1 in 3 would be enough, because the payoff would be so big if one struck gold, literally. Yeah, that's something I think people greatly underestimate, the value, the mathematical value of warrants, and how it completely changes the investment case if you get that risk-free upside. So I'm personally, I'm trying to get into as many private placements as I can, because then you can, since you get that extra upside, that means the case could be slightly worse as well. And it would still make mathematical sense from a risk reward and expected value standpoint. And if you get into enough of those plays, you actually diversify away the company risk a bit, but you keep the increased expected value. This might be, I don't know, maybe a bit complicated, but you diversify away the risk and you get added upside for no additional risk, since the warrants come free of charge.
Great. And I think now that you said that, people are going to want to know more about warrants. So could you just, for people that might not know, could you just explain why that limits the risk?
Yeah. It doesn't necessarily limit the risk. You have to diversify away the company risk. But let's say you buy a stock in the market at $1 and they have a discovery. It goes to $10. Okay, so you have basically 10 bagged your position. But if you get in at $1 and you have warrants at $2, that means that if the stock trades over $2 per share, let's say it goes up to $10 per share, you can then buy the $10 stock for $2. So the value of the warrant becomes 10 minus 2, because in that case you could simply pay the company $2 per share, and they give you something you can sell for $10 per share in the open market. So I mean, and that came free of charge, because when you do a private placement, you're buying units and you're paying just for the actual shares you're buying, but you get warrants for free. So that's basically a free option on upside, which greatly skews. I have a Labrador Gold, I think. I'm up like 1,700% on that, where I was at least a week ago. And that was possible because I had warrants. Otherwise, that would be cut in half, basically. I would be up like 900% instead of 1,700%. And it didn't cost me any extra. So that's one thing, again, it's like, if you can get into private placements with warrants, I mean, I see a lot of people like, yeah, it's a you know, a big hassle, and I get that. Most people don't know how to do it, and I mean, you really also need $1 million in net assets before you even qualify according to the Canadian whatever. So that also limits the field, obviously, which is a shame, because it really shows the, you know, that the saying is true, like the first million is the easiest. Because those deals, you can be in those deals when you actually have $1 million. So, but it would of course be easier to reach said million if you actually could be in those deals. No, warrants, great stuff. People should really think about it, dig into it, and realize that, I mean, it again, mathematically completely changes the case, because it supercharges the upside. So, which means that you would need mathematically less chance of success in order for the bet to make sense. So if you didn't have warrants, the stock might be trading at, I don't know, $1 and fair value would be $2. But if you had warrants, you might be willing to pay up to $1.9 per share, simply because you got so much added upside. It's a bit, I guess, hard to explain, but just try to read up on warrants and get the concept that you're not taking any more risk. The only thing you get is the potential of much greater upside. And that's obviously a bet anyone should make any day if they like the story. And sometimes the private placement where you get the warrants is also priced at sub where the stock is actually trading in the market. So I mean, again, it's like it's almost disgustingly good. It's like you're playing a different game if you get into private placements, because the I mean, what you get is so favorable that, you know, if you can do that versus someone else who invests in the exact same stocks that you are, you're going to blow their returns away, even though you didn't create or do anything different.
Fair enough. And you mentioned Labrador Golds, and just so we can understand your thought process a little more, like, what drew you to Labrador Gold in the first place?
That's a good question. I mean, it was one of my smallest positions, basically, because when it comes to position size, I want margin of safety, again, due to how compounding works. Because a permanent loss is a loss that you won't be able to compound. So, I mean, if someone robs me of $5,000 today, that's on face value, that's a $5,000 loss. But if I could have invested that $5,000 the way I've been investing, you know, the past years, that loss is gonna, you know, amount to hundreds of thousands in time. And that's why I try to stick to margin of safety as much as I can, but I do like to dabble. I mean, I like the excitement of a discovery as much as the next, you know, as much as the next guy. It's just I try to, you know, put some brakes on my greed, I guess. But that it was basically a neurology play. They had a land position right next to Newfound Gold, which has been basically the story of the year almost. It's gone up like 1,000%. So that felt like a relatively good punt, if you will. That okay? It seems that whatever they're finding super high grade gold. It looks like that should continue. That system or some form of that system looks to be continuing up to Labrador Gold's ground. But it was still very risky because they had no drilling. They hadn't, at that point in time, they hadn't even found any visible gold, I think. And hence the reason why I just, added a bit. But again, it was a good deal. I got into the private placement when it was cheap. Plus I got the full warrants for like 2 years. So that position grew from a very small one, which I didn't pay too much attention of simply because I didn't have that much money at risk. Now now it's maybe up 1,500%. Now it's actually a material position in my portfolio. So all of a sudden, it greatly affects me. But that started out, again, it's like it started out as a lottery ticket. I mean, the closest play almost to a lottery ticket I owned back then. And with the help of warrants and a large amount of luck, almost 15 bagged your money. And that, I don't know, I mean, that could still go a lot higher. I mean, who knows? So it just again highlights the fact that that was actually a pure bet, a pure lottery ticket, but you had the warrants, and when these warrants pay off, good things happen. But that's not something I expect to see much in my portfolio, a 15 bagger.
Right. And the important thing is that you're diversified among many companies. So the fact that you had a small position in this means that you were protected. It's not like you went all in on this. But I guess the question is, like, now that it's run up so much, when this happens, do you stay in if you're at the right price, if you got in at the right price, or do you sell because you're like, all right, it's come up so much, the odds of it continuing to go up are low. Like, should I just sell out for a trade, or what do you do at this point?
In reality, one should just look at any case in a vacuum. Would you be buying it now? Regardless of what, there are reasons, tax reasons that you might wait or sell earlier or whatever. But other than that, if we're talking just strictly risk reward, etc., and we assume that there won't be much in terms of transactional costs or tax shenanigans, then it's like, if you wouldn't buy the stock right now, you shouldn't own it. That's the gist of it, basically. The thing is that I think I have the shares and warrants in physical form. So it's going to take, I guess I have to send them to Canada to even monetize it. So the reason for me actually having stayed put in this story is, a lot comes down to the fact that I couldn't be bothered to, do the work of actually monetizing it. And at the same time, it's like it was early days. It was a conscious bet, like you said. I'm diversified. If that had gone to zero, that wouldn't have done much. It's that kind of money. But now again, it's like when it grows that much, now suddenly, I would honestly, the company is a banner sponsor on my site, but I wouldn't be piling in at this price. I don't think it's, superb risk reward, but that doesn't mean it can't go up 5 times more. It's just that, the story has gotten better because they actually hit the system. They've hit high grade gold. So it's more de-risked, and the probability of growth has increased because now they actually know that they have a high grade gold system. So it's not like, again, it went up, 1,000% or whatever, and nothing changed. That's not the case. The story has gotten a lot better. It's just that, is it a no-brainer risk reward at this point? Who knows? Nobody knows. It's just that I wouldn't have the position size I have right now if I could easily sell it. I would own some, but it wouldn't be like a top 5 risk reward proposition. It sure wouldn't.
Absolutely. And I just love what you said, that you don't hold a stock unless you want to buy it the same day, right? Would you buy it at that price, the same price you're holding it? If not, then you should probably get out.
Yeah.
Yeah.
Exactly. I mean, that's the only way to go about it, really. I don't get the whole, I paid so little, I might as well ride it or whatever. I mean, it makes no sense at all, really.
Absolutely, 100% agree. But it's psychologically, it's like, that's a pitfall a lot of people face. Yeah, and so where can people go to learn more from you?
Well, I have both website, the hedgelesshorseman.com, and I have a Twitter account which I am even more active on. I mean, I try to put something up on Twitter every day, and my profile is COMM underscore invest. So COM_invest, and COM with two M's. It's not supposed to be communist. It's supposed to be commodities. Commodities investing. So just putting it out there. So that's basically the best ways. And if you go onto my website, you can sign up for my newsletter. I send out, company news and stuff I write about, the new cases on a the send out happens every day, every work day at least. And yeah, you can read up on my previous cases. I have a tab that says, stock reports. And keep in mind that the dates, I mean, if you're reading one stock and you get bullish on it, then, you should be aware that that case might have been written a few months ago, and it's maybe up 200% since then. But at least you might get an idea of, how I think about investing, etc. So I think it could actually be helpful, even though you don't end up, buying the stock, etc.
Is there anything else you wanted to share?
No, just, thanks for having me on. It was fun. I ranted like I always do, but it's just, there's a lot of angles to this investing thing, and it's like I could probably talk for a few hours and I wouldn't have covered every topic the way I would have wanted it, but again, I had fun, and thanks for having me on.
This discussion is for informational purposes only. Nothing in this discussion should be taken as investment advice. Guests are not compensated for their appearance. Do not base any investment decisions on the information presented.